Next up, we have CSAA, and they're going to talk about the use of simulation and AI to build digital twins for insurance applications. Please welcome Bipin Chadha and Joshua Zhang. Welcome, guys.
Hello.
Hello. All right. Hello, everybody. My name is Bipin Chada. I'm the Vice President of Data Science at CSAA Insurance Group. And today with me, I have Joshua Zhang, who is a Senior Data Scientist with us. And today we're going to talk about how we are applying simulation and AI methods and tools to build digital twins for our insurance applications. So real quick about CSA, I won't dive into a lot of details, but just wanted to mention the kind of business we are in. So we are predominantly a personal lines insurer offering homeowners, auto, umbrella-like policies, that I'm sure many of you are familiar with. We also offer some commercial lines, sure, but that's a new business we are growing. We have roughly 2.6 million policies in force. We are in 23 states and DC. Over $4 billion in direct premiums written. So that gives you a little bit of a snapshot of the kind of business we have. So if you go to the next slide. Talking about digital twins and simulation, I just wanted to give kind of my perspective in this space. I've been doing simulation, building models, stuff like that for over 20 years. And I have an engineering background. So from my perspective, the theme we are following is kind of what probably got started with Wright brothers, when they started using wind tunnels to test out their airplane designs. And because of using that technique of and it wasn't quite a digital twin, right? So that was an analog twin back in the day, and its successful use allowed them to perfect their airplane designs, and rest is history. Okay, so that's kind of where things started. We started moving into a digital realm around 1980 kind of a time frame when folks were able to build a complete 3D model of an entire airplane, for example, and use that to test out several aspects of the designs. That idea, took effect, and started moving rapidly. So by 90s, companies were building, entire product structure, electronically of a, large-scale system like an airplane. Okay, so those kind of things started coming into play. And towards the end of the 80s, and 90s, this concept of what was called back then spot product model came into being in some of the DARPA programs that I was part of, which was essentially an idea to build a complete representation of the entire system. Let's think of maybe a airplane or a Navi carrier, for example. So this was a complete digital representation of the entire system, and you could play all kind of analysis and games with it, right? So these were, again, early attempts to achieving a digital twin-like capability. Around 2000 or so, AnyLogic came on the scene, or at least I became familiar with it and started using it. So, I've been using AnyLogic for a long time. And we started using AnyLogic to start building digital twins for various commercial companies. And I was involved in building many of those, over the years. Came into the insurance space after 2010. and built what we called a SIM USA, which was a digital representation of the entire, market space or the ecosystem for the insurance company, and that was a very successful model. And now I'm at CSAA Insurance Group, and we are actually launching off, building off something similar, for this organization that we are calling an Insurance City. And today you'll get a taste of a little bit of that work, and Joshua is going to be sharing that in a few minutes. It's important to know that what we're going to be showing you is not the real thing. As you can imagine, we're just showing you a demo model we put together, just to show, and none of the data you will see is real, and so on and so forth. So hopefully you get a little bit of a perspective of the kind of journey that has happened in this space over the years. So first, before we dive into it too much, I want to touch quickly on this notion of value generation. I believe all models are successful if they are helping the organization generate value, and the value comes from ability to make the good decisions, right? And that's where this progression that I'm sure many people have seen something like this before, or the different types of analytics, all the way from descriptive to diagnostic to predictive. Those are fairly common in machine learning, AI kind of approaches. But what really adds a good amount of value is when you can be prescriptive, which is if you can help answer the questions of, what do I need to do to be successful, right, and reach the goals, right? And that's where simulation techniques really start coming into play. So, and all the digital twin type technology we're going to be talking about right now essentially comes into play on the prescriptive side. So how does that happen? So if we go to the next slide, we all have seen how a typical machine learning or AI kind of a model is built, right? So you collect data, you create some features, you build a model using those features, and you make a prediction, right? And most people kind of stop over there. But reality is that the value is not created, by just being able to predict something. After you predict something, you actually have to take an action or make a decision. And when you take an action or a decision, value is created, but at the same time, there are also side effects. There are other things that can be touched by your action, and sometimes they could be positive things, sometimes they could be very negative things, right? And you have to be able to understand, what the consequences are before you actually, do take that action for real. And that's where the simulation techniques come into play and plug into the typical AI ML approaches, right? And to complete this whole life cycle of generating value. So this aspect is very, very critical, that often gets missed, by many AI machine learning efforts. So that's the reason we want to focus in on that. And a lot of the things we'll talk about today is to make sure we are bridging that gap. So if we go to the next slide, so this is how we see a structure of a decisioning model, and you can call structure of a digital twin model, if you will, is to be able to represent your decisions on the left, also representing external factors, and these would be the risks. Again, on the left, in the middle is the world model or the digital twin model, and on the right are all the objectives or outcome measures that you care about. Now, to build the world model, you need a wide variety of methods, and these are typical machine learning techniques, statistical techniques, techniques from operations research, game theory, and so on. They all come together to create this world model that then you are able to play to help make good decisions as we move forward. So anyway, with that kind of a quick background, I will hand it over to Joshua, and he'll tell you a little bit about some of the work we are doing and how it's taking shape. So Joshua.
Okay, thank you, Bipin. Hello, everyone. Again, my name is Joshua Zhang. I'm a data scientist at a CSAA insurance group working in Bipin's team. So now I would like to talk about what we have done in building a digital twin system for insurance. As a start, we need to understand the values to both insurer and to customers. So from now on, I will refer to value to insurer as V2I and the value to customer as V2C. So why would insurance companies care about V2C? CSAA is a customer-centric company. So we need to go beyond V2I, which is of interest for most insurers. What does the customer value? First, the peace of mind. By holding an insurance policy, the uncertainty is transferred to insurer. So you don't need to worry about what if something happens. Second, when a loss has actually occurred, the benefit is the payout from insurer. I will provide details about how to calculate V2C in the following slides. But V2I, again, this value to insurer is well established. Basically, it's defined as net present value of premium minus loss, expenses, capital cost over lifetime. So you can see both V2I and V2C are about long-term value. So how do we deal with the future time? Specifically, do we need to discount future cash flow? Due to the difference of focus between insurer and the customer, V2I is discounted because insurer's interest is about a return of investment, and the investment is actually put down right now. But for customer V2C, we don't have to discount because the value is realized when a policy is purchased or renewed. So now let me spend a little time on how V2C was calculated. For calculating V2C for each customer, we use the samples from theoretical distribution for auto insurance loss, home insurance loss, cash availability, and household income. These distributions are handy for quantifying uncertainty. So now we have already give you the building blocks. So we can talk about how the calculation was implemented in AnyLogic. We created 5,000 households in AnyLogic. For each household, cash availability, income, and the loss were generated from distributions defined earlier. Premium was provided by predictive models. We also adopted a couple of assumptions for estimating values. First, peace of mind is worth 10% of annual household income. Second, when loss is greater than cash, the adverse effect of cash shortage is 1.2 times of the shortage amount. We have formulas here, but I will leave them to you to read. So now, so far you maybe feel everything is abstract, but here is the specifics. So it's how AnyLogic model is set up. It's an agent-based model, and we have 5 state charts to capture changes over time. The state charts on top left and top middle are about insurance policies. Do you have auto and home insurance policies with us? If so, what kind of policies? Single car or multi-car for auto policy? Rental or condos policy or single house policy for home or property policy? On top right is the customer's life stage, single, couple, or single or couple with children. The 4th state chart on the bottom left is customer segment, non-preferred, medium, or preferred. This is related to customers' loss propensity and retention. The final state chart is actually an outcome variable. We only have 2 states, retain or cancel. We have the predictive features and outcome listed in the box. At each time point, the imputed predictive features were used to predict outcome variables. Here are the results for V2C, value to customer. The graph on upper left, the pink line, is the survival curve, which shows that 10 years survival rate is 25%. On the lower left is yearly V2C, which is decreasing due to attrition. After a customer canceled policies, the value for the years afterwards becomes 0. On top right is the cumulative V2C, which increases, but the increase rate is getting lower and lower due to attrition again. So now we can look at V2I results. So the survival curve is the same as before. So yearly and the cumulative V2I follow the same pattern as V2C. But the yearly V2I drops much faster. You can see here, drops very fast. And also the cumulative curve plateaus much sooner than for V2C. So why? Because both attrition and discounting drive V2I, that is value to insurer, to be lower, for the later years. So we can also visualize the results in AnyLogic GIS map. We put the 5,000 households on US map, and the V2I level is color-coded. Red dots stand for 0 or negative value, and the green dots for positive value. So now we have talked about V2C and V2I separately. Again, it's value to customer and value to insurer. Now we can bring them together. The blue bar chart is the distribution of V2C, which averages at $26,000 for 10 years. The green bar chart is the distribution for V2I, which averages at 387. This shows that insurance is a win-win business. It's valuable for both insurer and the customer. So here we have let me load this video. Okay. So here is just a the video telling you how it's run, how the results were obtained. So you can see the yearly results, they are progressing over time, right? But the 10 years results won't show until year 10. Okay, this is all I have. I will turn the time to Bipin for the future direction of the project. Let's go back to the slide again. Sorry.
Okay, so folks, hopefully you got a taste of the kind of work that's going on. Just a reminder that the data and the simulation you saw is just a demo simulation and demo data set. It's not the exact real information we are using, but hopefully you got an idea of the kind of games we want to play with with the digital twin model and the kind of decisions we want to drive. And this is just kind of the starting point. What we are looking to do from here is to help the business make a lot of different types of decisions. Things like hey, what customer segments should we be targeting? What happens if expense ratios go up and down? And some of these terms I'm using are probably more insurance specific. So if a specific term does not mean much to you, you can ignore that one. Or what's the impact of a pricing change, right? So if you're increasing insurance rate, decreasing rates, what kind of impact that'll have on the insurance ecosystem, and its impact on value, to the customers and to the insurer, both of those aspects. How do we better match risk to price, right? For example, and then how can we start using these kind of simulations for driving all kinds of decisions in the business. So with that, let's start going into the questions. Let's see. I see a question which says, okay, what you showed is a simulations. Why do you call the work a digital twin? What we showed you is a particular simulation representation. But behind the scenes, it's a digital twin because we are tying in data sets into our environment. And there are different types of decisions that will be driven by it, right? And again, digital twin, you could, I know different people potentially use different definitions of, what is a digital twin and what it is not. A lot of people look at a real-time dashboard and they call it a digital twin, for example. Maybe that's a definition. Our definition is that we have created a representation that is the alternate representation to our actual business, right? Now that we have that representation, I can run simulations on it. I can do what-if analysis on it. I can run optimization analysis on it. I can do risk analysis on it. So all the different types of things can be done on top of it. So hopefully that answered the question. If not, you're welcome to ask if you have some specific thing in mind. So I see another question around real-time data and versus simulation. So as you can imagine, the person who's using real-time data is probably trying to make operational, tactical type decisions, right? And that still could also use simulation, because a lot of times when you're about to make a decision, you want to understand what's going to be the impact in the future, right? In most operational situations, that future is maybe the next few hours or the next day, for example, versus maybe a more strategic level simulation where your future horizon may be 2 years, 5 years, 10 years period, right? So it's the differentiation between what's real time, what's operational versus strategic is many times that time horizon, can be different, but you can be under, you can still be using some of the similar kind of capabilities and let's call it near real time data, right? So nobody ever uses actual real time information. It's always somewhat near real time, if you will, right? So hopefully that answered that question. Any other questions at this point? Coming in. What parameters are we looking to optimize? So right now we have not been playing optimization game. With this model, there are potentially many different things to optimize. Based on the demo we showed you, you can almost see that this would be a great game to play to optimize both V2I and V2C, right? So if you think about a multi-objective optimization problem, and you're saying, okay, what are the best set of decisions to make so that on a, let's say, a 5-year, 10-year horizon, both V2I and V2C are optimized, right? That's certainly one, game could be played. Other games that could be played could be, how do you optimize for market share or optimize for profitability? Those are other potential, optimization scenarios, that can be implemented, again, at a strategic level, and so on. So we have not progressed to the point where we can actually start doing the optimizations yet. But that's definitely on the roadmap and the things that we want to do. How can you extend this model in the future? Maybe I'll hand that to Joshua and see if he has any thoughts about extending this model.
Sure. So we plan to add more variables, into the predictive model. So that's one thing, as BP mentioned. Both V2I and V2C will be in our focus. So the more variables, and we probably will extend the AnyLogic model to price application. The insurance premium rate making. So if you change rate, what will happen in long term, not just for 1 year or 2 year. So the most likely it will be at least a 5-year horizon or 10 years.
And then, coming to the last question I see is, what is the goal of your model as a decision-making tool in insurance? What are your expectations? So our expectations, and at least my expectation in starting this journey, is that today in the business, we make all kinds of decisions, right? And these decisions are, many times operational, and they're also strategic decisions that are made today. And as you can imagine, we try to be as data driven as possible, but the current methods and tools do not allow you to look at the problem holistically, right? When you're making a pricing decision, it's hard to look at the entire company ecosystem or even the market ecosystem, right? A lot of it is done based on experience, gut feel, including analysis and so on. But those are all done in compartments, if you will. What we want to do is bring it all together, right, in one environment, so we can play this kind of a holistic game and analyze every decision holistically. We are obviously not there yet, right? That's where we are headed.
Thank you guys so much. Thank you for that awesome presentation.